You ever look at a market chart and get that weird feeling of déjà vu? That sense that you've seen this exact pattern, this exact mood play out before? Well, today we're going to dive into a pretty wild analysis that asks a provocative question. When it comes to Bitcoin's cycles, are we all just living in a simulation? It's a feeling that analyst Benjamin Cowen put perfectly. It really does feel like you've read this story before. In that sense of a repeating script, that's the core of our simulation theory today. We're going to break down the uncanny evidence that makes these market cycles feel, well, almost pre-programmed.
So where does this all come from? Well, it starts with what you could almost call a glitch in the matrix, a coincidence in market sentiment so unbelievable it's hard to just brush off.
Okay, check this out. On February 6th, 2018, the Fear and Greed Index, which basically measures how scared or greedy the market is, hit a rock bottom 8. That's extreme fear. Now let's fast forward 4 years to the day, February 6th, 2022. The index, it was at 9. Almost the exact same level of sheer terror in the market on the exact same calendar date. A coincidence? I mean, maybe, but the story definitely doesn't end there. Yeah, that parallel in market fear was just the appetizer. The really compelling evidence, the part that makes this feel like a simulation, is when you start looking at what the price itself was doing.
Right, this is where the simulation theory gets really, really interesting. Let's look at this absolutely striking pattern of price levels from cycle to cycle that, well, it seems to repeat with almost mathematical precision. It's kind of nuts.
Let's go back in time a bit to the 2014 cycle. After a huge run-up, the bear market finally found its floor, right? A solid support level right around $600. All right, keep that number in your head. Now, let's jump forward to the next cycle's bear market in 2018. After another epic crash, where did the price find its major low? Yep, right around $6,000. That is an almost perfect 10x of the previous cycle's bottom. See where this is going? And believe it or not, the pattern didn't stop there. In our most recent cycle, the major capitulation event found its footing right around, you guessed it, $60,000. From $600 to $6,000 to $60,000. I mean, a pattern that clean is really hard to ignore. It's the kind of perfect order you'd honestly expect to see in a simulation. But, and this is a big but, it's not a perfect copy and paste job. You know the old saying, history doesn't repeat, it rhymes. The destination, that 10x price level, might feel eerily similar, but the journey to get there has been very different each time. To really get what that rhyme means, we need to compare how the price actually fell. Let's break down the key differences between that brutal drop in 2018 and the more recent one. And here's where you really see the rhyme. In 2018, the market just completely fell off a cliff, a brutal 70% drop in just 8 weeks. The more recent drop, it was a less severe 52% fall, and it took more than double the time, 17 weeks, to play out. So while the final price level felt like an echo, the path we took to get there was way slower and less violent. Now, despite those differences and how fast and how far we fell, there seems to be this predictable playbook that unfolds. And it's especially noticeable in U.S. midterm election years like 2014, 2018, and 2022. It's a sequence of events that has played out time and time again. So here's the playbook, broken down. It usually starts with a low in February. Then you get a relief rally into March that makes everyone feel optimistic again. But, and here's the key, that rally almost always slams right into a major resistance level, often called the bull market support band. That leads to a sharp rejection and eventually a new, even lower low in the spring. It's a frustrating pattern, but it's been remarkably consistent. So why does this pattern even exist? What makes it so effective at, well, wrecking everyone? It all comes down to market psychology. This sequence seems perfectly designed to confuse and trap both the optimistic buyers and the pessimistic sellers. There's a perfect saying for this. Bear markets make fools of both bulls and bears. They aren't just a straight line down, not at all. They're chaotic, choppy environments designed to play on your emotions and make pretty much everyone question what they believe. Let's just walk through how this trap gets sprung. First, a sharp drop creates total fear. Then you get this long, slow grind of a rally that goes on for weeks, making anyone who sold feel like a total idiot. Then confident bulls start piling in, thinking the worst is over. And then, bam! Right when optimism is back, the market gets rejected hard, trapping all those new buyers at a loss. It's brutal.
When you see these patterns repeat with this kind of regularity, it forces you to ask a really fundamental question. What is actually driving the price? Is it the daily headlines, the inflation reports, the latest geopolitical drama? Or is it something else entirely? So let's just recap the evidence real quick. We've got market tops hitting in the same quarter, cycle after cycle. We've got key support levels following this neat, clean 10x pattern. And we have these midterm years following the same frustrating playbook of rallies and drops. When you put it all together, it starts to look less like random chance and way more like a system running on its own internal clock. And that brings us to the core idea of this whole simulation theory. The idea that Bitcoin's price isn't mainly a reaction to whatever's on the news. Instead, it's governed by its own predictable 4-year cyclical pattern that's literally tied to its code. The news might create some short-term volatility, for sure, but the long-term script, it feels like it's already been written. So we're left with this one last thought to chew on. If the major turning points in the market are this predictable, and if the cycles play out with such rhythmic consistency, what role does the daily news really play? Is it actually driving the market, or is it just the noise we hear while the simulation runs its course?